Hello, I'm Steve Cantor. I'm a member of the Plimsoll-Mark Capital Global Investment Committee. I'm here today with Bruce Lewick, who is also a member of the Global Investment Committee, to talk about the forces of inflation and deflation that are at work in the global investment environment. Bruce, it seems that we have almost contradictory forces at work between inflation and deflation in the environment. How is it possible that we can be thinking about both inflation and deflation at the same time?
Steve, that's a very fascinating question, because we have not been here before if you look back through economic cycles. And the best way to look at it is to take each side separately to understand what's causing the inflationary and deflationary forces. It's probably clearer to look at the deflationary side, because coming out of the 2008 economic cycle, we have some very powerful forces still with us. Perhaps the most obvious one has to do with housing, with the severe decline in housing prices. Then we have unemployment, with unemployment still over 8% and not recovering as rapidly as had occurred in previous cycles. Then we have cutbacks in spending at the government level, particularly the state and municipal level, and very likely that will spread to the federal government level next year. And finally, we have the consumers attempting to reduce debt, paying off credit card balances. So all these forces are contractionary, and it's very difficult for an economy to make much progress against these headwinds. Yet at the same time, as we see daily, there are inflationary forces at work, primarily from rising commodity prices, and this is primarily being caused by growing demand for commodities in the developing world, especially China. So we have rising oil prices, with a barrel of oil now passing $100, and a gallon of gasoline approaching $4 in many places. And we have rising agricultural commodity food prices, which will eventually get into the entire food chain as companies have to pass along rising costs. So on one hand, we have forces that are tending to hold the economy back. On the other hand, we have forces of inflation. And the best way of relating both of these would be simply to go back to the question of gasoline. As consumers have to pay more of their discretionary dollar for gasoline at the pump, there's less money left over to spend in other areas of the economy. And it's like a balance. As more money goes into one area, there's less available for another, and that's why we can simultaneously have both forces at work, which is one of the unique characteristics of the current economic cycle.
So, Bruce, are you saying that the risks of inflation and recession are both about the same at this time? Is that Plimsoll's perspective on the environment?
See, the best way to answer that question is to look at inflation and deflation as two separate forces, as we have been discussing, and understand how each can impact our portfolios. On the side of inflation, we would suggest investments in those areas that are creating the inflationary problems, such as commodities, such as energy. We could look at a portfolio of diversified commodities. We could look at a gold portfolio with the gold ETF. And remember that gold historically has also been a hedge against currency debasement. We could look at equity portfolios that are focused specifically in energy stocks or in agricultural companies. On the side of deflation, what we really want to do is protect the purchasing power value of part of the portfolio. And the classic way of doing that is through bonds. We recognize that in a bond portfolio today, we are sacrificing some yield because the interest rates are relatively low, but for a portion of a portfolio that is appropriate in order to assure the stability through tougher periods. Remembering, however, not to hold longer maturity bonds, because the risk to principal in a longer maturity bond, if interest rates do begin to rise, is significant. And finally, remember that there is a major asset class that straddles both the inflationary and deflationary sides of a portfolio, and that would be common stocks. That the dividend and the growth of earnings gives long-term protection against inflation, because common stocks historically have provided a real return over and above the rise of inflation. In the short run, because of the yield of a common stock and the quality of the company in a well-diversified portfolio of global franchise companies, we will have some relative protection in an economic contraction when we compare that portfolio to other sectors of the equity market. So our approach to the issue of inflation or deflation is really driven by our three-part portfolio structure, with a core of common stocks, high-quality dividend-paying global companies at the heart, surrounded by a piece that is an inflationary beneficiary and another piece that gives us deflationary or recessionary protection, and at the same time giving us the flexibility to shift portfolio weightings from one side to the other if and when our view of the relative inflation versus deflation or recession risk begins to change.
Bruce, thank you for your comments.
Steve, it's been my pleasure.